Hey guys, good morning, welcome to another live session of Stock Sniper Trading. My name is Dave, guys, my partner is Ron. Let's get down to business here, guys.
In on US 30, sell, okay? I'm jumping in. Guys, that's a 100 pip drop. Yes, we caught it. Hey, guys, 200 pips, please, secure.
As a trader, we all look for tight or low spreads, which helps us to get in and out of the market. Using the right broker can help us try different strategies. With multiple options of brokers on the web, here at Stock Sniper Trading, we have a recommended broker, that is, HankoTrade. With spreads as low as 0 pips and leverage up to 500x, HankoTrade is just one click away. With multiple account types to choose from, you also have a minimum deposit of $10. Using HankoTrade's affiliate program, refer a friend and earn up to a 40% commission on trading volume. Built by traders, for traders. HankoTrade.
Hey guys, welcome to Stock Sniper Trading. This is our weekly webinar. Okay, it is Wednesday, October 11. We started 1 hour early today. It's 5 p.m. Eastern. What we're going to do is a continuation off of last week's webinar. We spoke about the bullish. We introduced the bullish family, important candlesticks, some patterns like 2-bar patterns and a 3-bar pattern. We're going to do the same thing with the bearish candlestick family. So now we're going to learn about the most important bearish candlesticks and keep going down from the most bearish to the least bearish, and to teach you how you should know that once you learn the bullish one, you got to learn the opposite one. Okay, so when I was learning these, I was learning that the bullish one is the brother and the bearish one has a sister. Okay, and they're opposites. Okay, so when we're talking about a bullish engulfing, from last week, we should know what a bullish engulfing candlestick is by now. Okay, now we're going to switch our mindset, and now we're going to think what a bearish bearish engulfing candlestick is. It's the same exact concept, but now we're going the opposite way. The market is selling. So now we've got to understand. And then we're going to learn about the next one, the next one on the bullish lineup was a hammer. Okay, so we're going to learn what is the opposite bearish candle from a hammer. It's a shooting star. And we're going to talk about what that is and the implications, guys. So make sure you know what the candle looks like. Okay, that's just a start basing point. But then once you start to learn more and more about the volume inside the candle, now you're going to start to learn, why does a green candle turn into a red candle? What exactly is going through that? Understand, guys, the psychology of what's happening inside that particular candle. And remember, this candle can be 1 minute. Okay, a lot can happen in 60 seconds if you're scalping 1 minute candles. Most scalpers stick with 5-minute candles. That's the traditional candlestick for scalping, is like 5. Not a lot of traders do the ones, but yes, ones are very popular. But 5, there's a lot that can happen in that time frame in 300 seconds. It can go from bearish and close bullish. It can open bullish and close bearish. It could open bullish, go down bearish, and close with indecision. So there's so much that can happen. So you got to understand what that volume is doing inside there. Who is winning the battle? Is it picking up the bids? Are the sellers pushing it down more? Like, what exactly is going on? So once you get more comfortable with learning what these are, it's going to make your trading much better. You're going to get more knowledgeable about the markets, and then you can make better informed decisions and maybe reduce how many times you're getting stopped out or trading on impulse candles or taking the wrong trade at the wrong time. Okay, and once we start to learn all this, we learn about the bodies, we learn about the wicks, the different candles, then we're going to move forward and start to identify support areas, resistance areas, how they turn to supply, how they turn to demand. And then with the knowledge you know about these candlesticks, you're going to start to see the reactions at these critical levels and which candles to identify to help you make better decisions. Okay, so let's get started, guys. So in this lesson, we will cover the characteristics of bearish candlesticks. Okay, so again, just to review, okay, we've done an entire webinar on the open, high, low, close. We also did a brief introduction on the bullish webinar last week, but now notice the difference. Remember the bullish candle last week? We were opening down here. It's opposite now. Okay, this is the bearish candlestick, so it opens at the top. Okay, so OHLC, for you guys that don't know what this abbreviation is, open, high, low, close of a candle is how price movements and volume are displayed on a traditional chart. Okay, and there's different type of candlesticks. Okay, there's so many different times. This is the traditional Japanese candlestick where it all started. Okay, this I'm not a historian, but the Japanese invented these type of candlesticks in the early 1800s. Okay, they used to trade rice with these, like when they were trading rice as a commodity. Okay, so they were using this is the traditional trading candlestick. Now there's modern candlesticks. There's hollow. There's Hakanashi. There's Renko. There's footprint charts. There's so much new technology out there. But if you like the old school traditional style, this is the candlestick for you. I prefer trading old school style. It's been around, tested, and still on our charts till this day. But if you want to try different type of candlesticks, go ahead, but just learn what they are. Okay, but this is our traditional basic candlestick most of you guys are familiar with. Okay, so price opens at the top. Okay, very important. At the top of the body of a bearish candle. It's not going to open down here unless they kind of gap it down. Then we know something is going on in the market. There's some type of manipulation. Something doesn't add up. Something is not right here. What's going on? Ask questions. Anytime there's an unusual open on a bar, make sure you're asking questions. Okay, say what was that? Why did it open over there when it should have kind of opened over here? Then it kind of gets you thinking of what's going on. Okay, so it might also help you as a trader. We just seen that this weekend. On Friday, the markets closed. We had conflict in the Middle East, and Sunday night gap ups, big gaps in the market. Okay, so ask yourself, why did they gap up the market? Okay, what is the reasoning behind that? It was done for a particular reason. Why? Maybe it's to give the week a head start to continue to move bullish. It might be a harami candle that gives us clue as to what's going on in the market if it closes in there. So just so many things that can happen with open and close of these bars. Okay, so bearish opens at the top of the body. The high, okay, the wick. Again, these are, some traders call them wicks, some traders call them tails, some traders call them shadows, some traders call them sticks. Okay, I'm not here to argue about what it's called. Whatever you want to call it. I don't care what you guys call it. You can make it up your own name. I don't really care. But make sure you understand what is going on. I see traders these days are too occupied on what they got to call it, if they're calling it the right thing. Honestly, I don't give a shit what you guys call it, okay? But understand that it opened and it went up here and then got rejected. That's what you got to know, okay? And that created the high of that time frame. The low, the lowest price of the candle, creating the bottom point of the lower wick. Okay, so this, again, whatever you call it, tail, wick, shadow, stick, I don't care. What happened down here? It came down in that particular time frame and made the low down there. But did it close at the low? No, it just got a little bit of bids and came back up and closed right here. So when we go through a bearish candle, this is the body. Okay, when I'm trading, I always, my eyes always look at the bodies. Why? Because the bodies represent the real volume. That's where the volume is. The wicks are nice. They're very important too. Don't get me wrong. I do wick analysis as well, but I put more emphasis on opening and closing where the volume is. But I also learn what's going on with the wicks. That's the range. So that's how high something went up to and how low. So just a quick example. Let's say something opened up at $10 right here. The market today opened up at $10 and it had buyers right away at the opening. Let's say this is a daily candle. Right at the opening day, there was buyers and it went from $10 to, let's say, for example, $12. And remember, this is an entire day of trading. So when it came up there, it had resistance. It had selling pressure and they pushed it down. So it came back down, back down to where it opened from $12 to $10. Then we continued to come down. The sellers were in control, pushing it down. Did we ever come back up to test up here? No, the bearish volume is coming down, coming down, coming down. And then let's say, for example, near the end of the day, now it's like 3 p.m. power hour. Now the market went from $10, $12, and it's all the way back down to, I don't know, $7, okay? And then when it came down there was a lot of bids that came in to buy the end of the day at a discount of $7. And then it came, and then this is the closing price where it closed at, I don't know, $8. Okay. So that's the entire move of that day. So we close now, just walking through it. Now, if I'm trading the next day over here, what do we think? How is the day going to open? Okay. This is a question for everybody. If this was a daily candle and this is what happened, it opened, there was buyers, but then they got rejected hard. It came down, pushed near the low. And then look at the closing price. It's almost near the low of the day. A lot of volume. We have a lot of selling volume in the market. So I would predict that the next day would either open right here at the close, maybe open, or they'll gap it down a little bit to continue to maybe take out that wick and drop a little bit further because they can see maybe a big block of bids down there. Maybe they want to come down early, pick up those bids, and then maybe reverse the candle, and then it comes back up, and then it might be turning green. It might be coming up bullish. And then we come up. But what I also look at is the psychological point of 50%. So I'm looking at the opening price and the closing price, and right away I'm eyeballing 50% right there. Okay. You don't need to, like, you can literally eyeball it where you think is 50% and just draw a line. So now if it's coming from down here, if it's coming up buyers, 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 I hope that it gets rejected at 50%, and then selling pressure will still push it right back down, and maybe we'll continue pushing down. But if buyers bring it back up and close above 50% or more, then I got to give the momentum to the buyers. And then maybe the next day it might open up and then continue to go back up. So maybe $7, $8 down here was a great buying opportunity, and a big block came in, absorbed all of that, bought everything, and maybe it's turning back up. But it might also open red, continue push down, take out the low, and then we continue go down to find the next area of support. Okay, so that's an open high low close of a bearish candlestick. Very basic. Make sure you understand this, and this is what it looks like on a chart. So we're going to talk first bearish engulfing candlestick. Remember, the most important bullish candlestick last week was the bullish engulfing candlestick. It completely engulfs a previous bearish candle. So now we're talking about the opposite. If we want to sell the market now, let's say the market is really red. You can make money when the markets are red. Bulls make money, bears make money, and pigs get slaughtered in these markets. If it's a red selling day, then learn your bearish family of candlesticks, because maybe you could be selling with the market and selling the pullbacks, and continue profiting with a bearish day. Some traders are scared to trade when it's a bearish day in the markets. They only prefer trading bullish days. I don't care if the day is bullish, bearish. I don't care. Once you understand your candlesticks, you can trade both ways. You can scalp up and down. You can do whatever you want. Okay. But learn this stuff. Okay. So let's go over just the technicals of what a bearish engulfing pattern is. Okay. So a bearish engulfing pattern is a 2-candle pattern that signals the potential for a reversal. This is shown on the chart as a large-bodied red bearish candle that completely engulfs. So remember last week we were talking about this word engulfs. It completely engulfs the previous bullish candle. You see it opened up here and it closed down here. It completely engulfed all of those buyers. Engulfed, swallowed, whatever you guys want to extinguish. Some people say extinguished. Whatever you want to call it, again, make sure you understand that it completely took out the previous candle, engulfed it. So the momentum is leaning towards high probability that the market is going to continue to sell down. Okay, so make sure we understand what a bearish engulfing candle is. The bearish candle opens at or above the previous bullish candle's close. Okay, so it also throws off traders if it kind of gaps up. It's not always, see here, the bullish candle, we opened at the low, came down, made a low, came back up, made a high, and we closed right here. Our next candle can open exactly where it closed, right across at the open. Okay, but in situations like this, maybe you're going to see a candle that gaps up, kind of gaps up and doesn't break the high, or maybe just a little bit breaks a high, but then comes down hard. So we know that they're manipulating the move to come up to maybe catch some offers up here and maybe push it down with more volume. Okay, it's not always the case. Sometimes it gaps up, it will come down bullish and then continue going up bullish. But that's why take your time when you're looking at candlesticks. Don't just make impulse decisions on every bar. Make sure you understand what's going on. So could this one gapped up? And then in this particular situation, it kind of looks like tweezer tops came up here and then started to push down. Okay, so the bearish candle opens at or above the previous candle's close over here. Okay, and it came down. Normally I'm looking right here, 50%. As it's coming down, I want to see if there's a reaction right here. Normally I have a line at 50%, and maybe it comes down red. Maybe it stops right there and catches a wick, catches big bids, and then all of a sudden it's coming right back up. Then maybe looking to continue to buy if it holds 50%. But in this situation, it kept coming down. It broke 50% and continued to come down where the previous bullish candle opened, and we continued to push down. We even took out the previous low, and it sold all the way down here and closed. So we have now information that this candle completely engulfed the previous buyers, closed near the low. And now the next candle is probably going to open red. It might come up a little bit. So when I'm trading, I always assume the next candle is going to open up opposite. Like it's going to open up in bids, because it drops so far down that there's going to be probably some buyers wanting to buy right away. So what I do is I see it open. If it opens green, I see it come up. But they have a big, tough job to do. You're buying against all of this selling pressure. Okay, does that make sense, guys? When you buy now, you are going against all of this selling momentum. So even if you buy, it might come up green, and then catch a wick and then start to go back down because the supply is being lowered and you're being absorbed on your buy. And then they might continue to push down with higher time frame selling pressure. So I assume it's going to open green, and maybe right here at this critical level, I see if it can come up and test right there, the previous structure. And maybe if it gets rejected with a wick and comes down, maybe it might push. I might go into a further sell or hold my sell. But I always look also, and then I identify 50% of this big red bar. Where's 50%? Right about there. If it can come back up and get rejected and push down, I might continue with this selling pressure and trade with this momentum going forward. But that's more advanced stuff. I just want you guys to learn what a bearish candle engulfing is. So can I move forward, guys? Do you guys all understand? It engulfs the previous green bar. Last week we were talking about bullish engulfing, where the green candle completely engulfs the previous red bar. Now we're selling the market. So sellers are in control. So that is your most strongest bearish candle, is your bearish engulfing. Okay, so this is number one. And where these things are created adds context and putting the piece of the puzzle together. If a bearish engulfing candlestick is just created in an area of consolidation or range, then the next candle might open green, come back up, next one red, green, red. You know, when we're barcoding where it's green, red, it's not really moving the market, it's consolidating. It also depends on where these things are created. So I would give more emphasis on selling the market if this bearish engulfing pattern was formed at an area of higher time frame resistance. Okay, I give more emphasis on that. That's where I would like to see more sellers come in the market at an area of resistance, or maybe like a supply area, as opposed to just buyers and sellers accumulating in a range. Then you're going to be going up and down. You're accumulating a move. You might get squeezed out of the market and things like that. So what we look for is we look for bullish engulfing candles at areas of support or higher time frame demand when the lower frames are getting really, really oversold, because that's where we want to see a big block of buyers. And then if we see a bullish engulfing candle, that's where we want to buy. The opposite is to sell the markets. So if the lower frames, what I mean by lower is 5 minutes, are getting really, really overbought, and then I see it coming to maybe a 4-hour area of supply, because I've done my top-down analysis, and the 5 minute candles are getting completely overbought lot. It's been a big bullish run. There's got to be some time where the sellers come in the market. And then if I start to see at that supply area on a higher time frame, I start to see a bearish engulfing candle start to engulf the buyers. That might be the opportunity to look for a sell, and that could be the start of a move. And it might just come down, but then again, the pullback, and that's why we look for double confirmation. You know, when we look for M tops, double tops, we look for additional selling volume to come back into the market and push the move. Maybe it might not be enough, just one red candle, because you have a lot of buyers. So then they might bring it right back up, but then we look to see the second top if more selling pressure comes in. Is it either going to be like another bearish engulfing candle? Then that might give us the move that we're looking for to reverse the market and sell. Okay, so there's context behind these candles too, where they're formed, not just because you identify it. Okay, that's one piece. Everyone can identify a bearish engulfing candle, but put the next piece together. Where are they more important? In what area? Does that make sense, guys? Alnita, sorry. On the last sentence, does the size of the bullish candle impact the bearish engulfing? Does the size of the bullish? No. Like if this is the bullish candle and the bearish one comes down, what we're looking for is to engulf the previous bullish candle, one. But let's say there was another green candle right here, two green candles, and if we get one big bearish one that can engulf two green candles, then we know that these sellers are really, really pushing the market down because they've engulfed not one, but two bars with one single one. So then the next one might start the momentum really pushing down in the market. So, but we'll go over that. We'll look at all of those. Okay. So I'm going to move forward, guys. That's a bearish engulfing candlestick. Okay. So here's a chart, bearish engulfing candlestick. So this is a pattern, okay? So we can start to see like a support level down here where it came down, held, okay? Critical volume, hold here. Then we got this big bullish engulfing candle. So from last week, this is like a morning star pattern. You got your red candle, you have your little inside star, and then you got your big bullish engulfing candlestick close above here. So this could be a nice buying opportunity to maybe test out a buy up here. And in this situation, yes, it did push up all the way up to here, a previous area of resistance. So maybe if I was looking to the left of the chart, I would have probably seen that this was maybe a 15, 30-minute hourly resistance. And I see the 5-minute candle starting to come up here. And there was a bullish candle that broke out impulsively, but then closed right here. Then my next bar, again, opens side by side. So they don't always gap up. They might open side by side. So this one opens right here on the close of the green one. It came up bullish. Initially it was bullish. You see it turned up green and came up. But did it fill the previous wick? So that's what I also look to. I do also, like I look at wicks as well, okay? So not only just do I look at bodies or where they open close, I also look at the previous high, okay? So it came up green, but then right away they pushed it down. So that's telling me that they lowered the offers from right there to there. It's kind of like they want to push the market down without creating a new high. So here we see the rejection on the wick. That was the high of that red candle. And then we come down, we start coming down, bearish, bearish. So what happened at around 50% of the green candle right here? We normally would see buyers come in or a reaction. Maybe this candle had a wick. Remember, it's 5 minutes. So there's a lot that can happen. This might not just be a red candle that just comes down. Maybe the first 2 minutes it came down here, caught a wick and came back up. But then when it was coming back up, more volume pushed it right back down. Now the entire 5-minute candle closed down here. And you can see that the entire red volume engulfed that previous green bar at an area of resistance. And now maybe we would look for our confirmation to take the sell. So I assume the next candle is going to open green. It did. It opened green and it came up. You can see the wick. So it opened green. It came up. I always judge whether it's going to stay below 50% of the volume so that I can continue with this momentum selling the market down. So I see it come up. It didn't even come up into 50% and it got pushed down. And then using wick analysis, how long is the wick on our previous bar? There is no wick, so we know it closed near the low. So this is kind of like that firecracker where I tell you where it pops, and then there's your drop. As a scalper, like this could be a 1-minute candle that we look for this move, and that drop could be 10, 15, 20 pips, depending on the security you're trading. Okay, remember this is GBP USD in this particular example. Okay, so the drop might be 5, 7, 10 pips for GBP USD. For US 30 or an indice, this might be 15 pip move. For gold, that might be like a 10, 15, 20 pip move. Who knows? Okay. But that's why I also use my measuring tool to measure when it comes down to another location. So here came down red. Again, this one opened green, came back up below 50%, continue push down new low, close as an indecision candle in the middle here. Next candle, green, open, still staying below 50% of this red candle. The sellers are still in control. No green volume closing above, and it came all the way down to tap the previous area of support. So when we're talking about where do we take profits and where should we be scaling out, well, that's why it all starts from the top down. When you understand your zones, now when you understand your candlesticks, now you trade the bars in between the zones. And then you see here, okay, the buyers came back in, brought it right back up. But again, the selling pressure continued to push it back down. Here we got another ignited red bar, continue come down, close near low. Again, another bearish candle, close below the zone now. And now it could have continued to dump because we lost this area of support. The sellers are in full control. How did they get it? It all started up here with a big bearish engulfing candle. The pullback that came right back up were lower highs. They lowered the supply lower and really brought it down. But it all started with a bearish engulfing candlestick. Okay, so let's continue moving forward, guys. Number two. Okay, so once we understand what a bearish engulfing is, that's your strongest bearish candle. Number two in the lineup is a shooting star pattern. Okay, and some traders always say, Ron, the second bar, shooting star is not the second most bearish candle. It's this one, it's that one, is this one, is that one. Okay, there's always going to be opinions from everybody. This is one thing about trading or anything you do, like even in your own profession, you're always going to find someone that's always has an opinion. Okay, so I respect everyone's opinion. Honestly, I do. I respect everyone's opinion, but I'm not going to change my opinion of what I believe is price action because I've been doing this for a long time and it continues to be positive for me, continues where I'm successful in these markets. So if someone wants to argue and say, Ron, a shooting star is not the second most, it's a bearish pin bar is the second most, I don't really get into that. I get into facts over here. I go by where it opened, where it closed, where the momentum is. So in a shooting star candle, sorry guys, do you guys understand what I mean by that? Okay, I'm not here to get into politics about which candle is like technically the second most bearish. I don't know. Did you guys do studies on probabilities and things like that? I just study the volume. So in this particular situation, why the bearish engulfing is so strong is because it closes near the low and it engulfed the previous buyers. So to me, in my opinion, that is the most bearish candle there is. Okay, you've completely extinguished the previous buyers out of the market and you're closing near the low where most selling pressure is going to come in the market. And then you got fear of these buyers that are going to get stopped out of the market. So they're adding fuel when they get stopped out. Okay. Now our next one is this candle. Why is this one, in my opinion, the second most bearish? Because the entire flow of the volume in this bar. Okay. This candle opens green. It opens right here. And it came up bullish, 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 where it hit a high. Okay, maybe it came to an area of resistance. And when it came up here, what happened? It got rejected. You can tell by the upper wick. It came up here and got rejected, 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 rejected. Now we came back where we opened. And look at what happened at the opening price. It came back down where the sellers controlled it completely and they closed it right near the low. Okay, so just going through that, for example, if this was a 5-minute candle, the buyers bought right at open. For the first, let's say 3 minutes, the buyers were in control of this candle bar. They were in control right up to the top. But when it came up here, maybe it was coming to a higher time frame area of resistance, a big block of offers, a lot of supply. They absorbed all of those buyers and then they just sold it hard on them. And then they started to turn it down. So those buyers now are in drawdown. Okay, and then look at what happens. It comes even below the open. It really pushes them, you know, like strangles them to make, and then closes right at the low. So you have all of the selling pressure close. If this was a 5-minute candle that closed, it closed right at the low. And next candle might open with that momentum carrying forward and be bearish and really continue to push down. Okay, so do you guys understand like how this candlestick changed? From color, from momentum, where it opened with buyers and came up, That was like an impulse move. It opens, first couple minutes came up, but we can't always judge a full candle just on an impulse. I don't judge a candle until it finally closes. When it closes, I get information. Okay, do you guys understand that? Am I just talking to myself here, guys? You get a lot of information when the bars close. You're guessing when you're taking impulse trades. You're basically guessing. Okay, that's why when I take an impulse trade, if I'm in it for a couple minutes, I pip and I dip out because I don't know what's going to happen for the next couple minutes. I'm just happy I got in, got my money, and I'm out. Then I'll continue to follow once I get the close of the candle. Then when I see more information, like what happens if I came in here, I initially bought this candle, I went up 10 pips, I secured, got my money out of the market, then all of a sudden it's coming down and it closes down here. I already pipped and dipped out of the market. I got my money, I'm good. Now I can watch down here, it closes. I can now switch and I can start selling the market with the momentum as a scalper and continue. Otherwise, just if you're not trading that, observe, stay on the sidelines, be a spectator, observe what's going on with the volume, put the pieces of the puzzle together. It's going to make you that much better of a trader. You're not going to be over trading. You're not going to be taking impulse trades. You're going to be taking more calculated trades. Okay. I want to make this so clear to everybody. There's a lot of traders that are still struggling, but have you really dialed into your bar analysis like this? Do you guys understand how important the open, high, low, close is? And not just looking at the color of the candle, to understand the flow of the volume. There's a lot of information that you can get out of this thing. A lot of information. You can kind of see the emotional swing of this candlestick. In 5 minutes, you can see that buyers were in control at the beginning, and then all of a sudden sellers closed it at the bottom and they're in full control. What's going on with those buyers that are in there? Okay, they might continue to get squeezed down. Okay, so that's, in my opinion, is the second most important bearish candlestick. And when you look at this, it's kind of the opposite from the hammer candlestick, which is the second most bullish candlestick. Remember the hammer? It comes down exactly like this, opposite, but with a green head at the top. Why? Because it opened red. Then when it came down, it met support and it came back up and it closed at the high with a big green body. So that to me tells me exactly what I just said, but the opposite for buyers over here. Okay, so the shooting star is a bearish reversal candlestick, indicated peak or top. The shooting star should form after at least 3 or more bullish candles indicating a rising price. This represents that the sellers are taking over the price action and pushing the price down as sellers outweigh the buyers. This candle is establishing a downtrend until the next bullish reversal. Okay, so just reviewing, does the color of the candle matter, Elizabeth? Yes, it does. Because if this one kind of closed, see how it closed red. Okay, see how it closed red? Then we know that the sellers are in full control, closing at the low. If this one closed like here, where it opened green and came back up and then closed with a green body, then it's an inverted hammer. And we know that there's still buying volume. There's still a leftover buyers that are still left in there. So then maybe the next candle will open up green and continue maybe with momentum. That's what was left with the buyers. But this one with the big red body is showing us that it closed with a lot of red sellers still in the market, right at the low, and maybe possibly ready to push the market down now. So let's take a look at how it looks on a chart. Okay, so see this chart over here? This is GBP USD on the 5 minutes. See how the red bars, sellers are pushing the market down, and then it comes right back up. See a local support level where the volume is right around here. And then we open bullish, a big, nice bullish engulfing candlestick, engulf this little guy right here, and roughly 50% of this big red bar. There's our resistance. And then look at now. So our next candle, again, opened green, no wick on the top. You know, when I say, guys, I'm taking an impulse trade here, it opened green, there's no wick, there's going to be a pop. Sometimes I'm taking that on a 1 minute, 5 minute candle, but my like what's going through my brain is I'm kind of just trying to get my pips and see what will happen up here. If I try sometimes, maybe if I'm buying on an impulse, I get out, maybe I measure the move, maybe 10 pips, get in and out. Unless it's maybe pushing, and then if it closes above here, I might continue with bullish momentum. But if you don't even take a trade, for example, if you don't even take an impulse, remember what Ron says, best thing to do is wait for the candle to close. If you waited on this candle to close, look at now the information you get. Okay, this, if you just bought when it opened, like these buyers that did, it came up green. let's say for approximately 10 pips, okay? And if you didn't do anything up there, not a lot of traders pip and dip fast. A lot of traders are looking for more than 10 pips. They're looking for 20, 30, and they got their stop loss down here. So, but look at what happened if you just waited for this bar to completely close. It came up green, it came down red, and look at where it closed. It closed right down the low, shooting star. They closed the volume below 50% still of this big red bar, below this resistance level. So that's telling me that selling pressure is still in control from up here. Okay, they're still pushing down the market. Now what I look for is maybe like this candle to open up green, get rejected, and then I'm in a sell. So I would look to sell right here, place my stop loss either like just above here, that's really tight, or above the previous high, because that's where I see it came up and those buyers got rejected there. So if I take the sell now with confirmation, shooting star candle, I'm looking to get in the market and sell with this momentum, continuing to push down. Maybe this was just a pullback on buyers. They got caught, and now the market will continue to push down. But I don't know that until this candle forms. This candle gives me a lot of information. So I see that they faked out the buyers on the impulse, brought it right back down. They closed near the low, and then here's the open. It opened green, retest the red line, and drop right there. Sell, stop loss, maybe above here, and then ride it down. I normally ride it down to the next support line. I measure that move. Let's say, for example, it's 10, 15, 20 pips, whatever the security you're trading. I know at least to maybe take out some profit there, scale out, go to a break even, you know, all of those other things. But this one continues to close below. Look at the red bar. Volume body closed below the previous bodies. So just that little tiny close, even if it's 1 pip, okay, that can change the entire order book. That can change everything where it closes at these specific levels. I know a lot of traders don't even pay attention to this, but that can completely change the entire order book. You'll see a ton of pending offers if it starts to close below critical support levels. And then you'll start to see the bids start getting pulled because they're scared, because the market is going to start to come down now. So when more offers come in the market and buyers pull out their bids, it kind of opens up the floodgate for the market to fall down until the bidders are repositioning themselves at a discount. So maybe they're seeing, okay, it's going to come down now. Instead of me buying at 136.65 here, maybe I'm going to put in a pending order at 165.60, 5 pips lower, maybe to get it on a discount. So that's what we got to find. But while that's all happening in the book, you're profiting on the sell because you sold at the perfect time. Okay, so see how this candle, how this pattern rotated right back up, but the shooting star candle kind of really pushed the market down. This is a statement candle. This is like the sellers are saying, you're not going up anymore. We pinned you. We got you down. We closed it below shooting star. It's down at the low and then started this next move down. Does this pattern always work out when you spot it? Absolutely not. Of course not. Okay. But there's context behind it. Where, when, how, the overall move. So we have a trend coming down from up here. So sellers are in control, pushing it down. This is a small pullback. You get your confirmation candle, and then you can continue selling with the market. Okay, so does that make sense, guys? Shooting star candle is very, very important, but just understand that this thing opened green, came up green, 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 but remember that just made the high of that time frame. This can be a daily candle. This can be a 4-hour candle. This can be a 1-hour candle. That's the beauty of candlesticks. Once you learn them, you're the boss of the time frames. It just depends on what type of trader you are. If you want to, this could be a 15-minute candle. This could be a perfect 15-minute setup to sell the market. Okay, you don't always got to trade 1-minute, 5-minute candles. You can pick and choose what time frame is best for you. Okay, so that's shooting star. Let's move into what a bearish harami pattern is. Okay, so this bearish harami kind of maybe like mid-level, neutral, in the middle, third on the lineup. Okay, but it is kind of like a clue candle. Something is manipulated here. Something is bound to happen very, very soon, kind of giving us a heads up. Okay, like this week, if you saw the gap up in the markets because of the crisis on the weekend. Now it's interesting to follow where the weekly candle is going to close. Is it going to close inside? Is it going to completely engulf? How are we going to move into next week? These are things that you should be looking at. Okay, a bearish harami is a 2-candle pattern indicating that a bullish trend may be reversing. The red bearish candle is contained within the body of the green bullish candle. The bearish candle opens lower than the the previous bullish candle's close and closes above the previous bullish candle's open. The pattern indicates a potential decrease in buying pressure and possible trend reversal. So looking at the bullish candle, we opened, made a low, came up, closed up here. All of a sudden, let's say this is a daily candle. We closed up here. Why all of a sudden for the gap down to open it down here? What is the reasoning behind that? Okay, there's always something behind it. Okay, so they manipulated the move down here. Why did this red candle not open right here or kind of gap up? But they gapped it down all the way down here. And in that trading time, it came all the way down here. Did it come to take out the opening price of the green or the low? No, caught a higher low and then closed. Look at where it closed. So it closed red right inside the heart of that green body. Okay, so another word for harami we talked about last week in Japanese is pregnant. Okay, so think about the mother and the baby. Okay, so this is the baby inside the mom's stomach. Okay, the Japanese kind of made that analogy. That's what harami means. Okay, so it's inside. Okay, so we don't have enough confirmation to take a trade because it closed inside. Okay, it's kind of like neutral. Okay, it's 50-50 still, but we can lean towards maybe selling pressure to reverse the market. Why? Because why was it manipulated to push down originally? Okay, that's the question. It didn't open up here, so they kind of manipulated it to open down here. They're kind of giving it a head start to push the price down, but when it came down, we couldn't close below the previous green bar. So we still got to respect these buyers in the market. There's still buying volume left. This is where it closed. But now it's giving us a clue that maybe we should watch maybe the next candle. Maybe it will push down red and close below there. Then maybe we can continue to go down. Okay, so this is the harami pattern. This is how it looks like on a chart, okay? Just for example. So we had the bullish pressure continuing to make some highs. And then look at here if you can see it, okay? So our bullish candle kind of gapped up and closed up here. Again, why did the red candle not open side by side or gap up a little bit, but instead they gapped it down? This is where they opened it. And then it came down, but also closed. Always look where bodies close. That is more important than just where they went to. Okay, where they close is very important. Okay, you know, if I say to you, guys, let's go to the grocery store. Okay, you know, when you go to the grocery store, you can go to the grocery store and I say, hey, Carlos, can you go to the grocery store and can you buy me some milk, right? Carlos can go to the grocery store and come back in 10 minutes with my milk. Okay, he went to the grocery store and came back. Now, what he did going there, whatever direction he took, I don't care. That's on him. Whether he took the shortcut, whether he took the long way, I don't really care. All I asked Carlos was to do was go to the grocery store, get my milk and come home. Now, if he wants to tell me the entire analysis of how he got there, that's kind of like what a candlestick is telling us. Where it went, like where it came down to the low, that's where it came down, and then the high. But I'm more important where it closed. Like to go to the grocery store and come back. That's what I'm important. The stuff inside, okay, if you took a shortcut here and there, it's useful, but it doesn't really, I want to know more critical information. I want to know, did you go to the grocery store and did you come back? That's the most important thing. And did you get my milk? That's what I'm worried about. Whatever you did going there, it doesn't really tell the story. Okay. So in here too, this candle opened, they gapped it down. Why? Ask yourself why. Why are they gapping it down? There's a reason for everything. They gapped it down because they're manipulating the price down to give it maybe a head start to push it down, maybe giving us a clue. But when it opened, they gapped it down, opened up green. Okay. We came up strong, took out that high. But again, follow the candle until it closes if you can. Stop getting involved in impulse trading. It came back down, it got rejected and came down here. When it came down here, met some buyers on a higher low, but look at where it came back and look at where it closed. So you can see it closed right inside the belly of that big green candle, okay, 50%. Now we start to use our clues that maybe the market is pushing down. Our next bar opens ignited red. It doesn't come up, no bullish pressure. It comes back down. It fills that wick, and look at where it kind of closes. Right by this previous resistance level. Okay, maybe now turning to support. And now we get it closing right down there. I would have liked if it kind of closed below the red line, but sometimes we got to use our intuition as to what's going on. Then the next candle again, opened up green. Did it come up to 50% of this red bar? No, It got rejected early. How long is the wick? Is it a long wick to fill? No, it's a pretty short wick. So right there, that's where I would possibly enter the market on a sell. Okay, is all gave me the clue of the harami. Then this candle starts to come down, close below, and then this is what I would do. I would take a sell here, and then I would place my stop loss. It depends on what time frame I'm trading, how much I'm risking. But number one, guys, you guys got to give yourself some room to breathe. Don't just get into a trade and give it 3 pips, 5 pips stop, unless you're super scalping. Okay, but if you're trading, give it some room to breathe, just in case there's a small pullback, and then you still get rewarded. But number one, look at structure. Maybe place your stop loss above the gap down candle, maybe above here, maybe above here, but give yourself some room to breathe in case like it comes back up for a double top and then they really pound it down. But then you're already in the sell, but give it some room to breathe just in case. But this kind of clue candle gave us a little bit of information that the market started to push down. Okay, and then again here, see this previous green level at those body, it closed below. And then look at, they gap it down to kind of help it push down, and then it comes up green, right up to the green line and rejected. Short wick, and now it's pushing down. You could continue with your sell. You could maybe hold trades longer, guys, if you're watching candle by candle, start to lower your trailing stop loss at every successive body. If it pushes away, bring your trailing stop loss. Like for example, if you sold here and then you see it close below here and pushing down here, bring your trailing stop loss right here, 50% of this red bar. At least you secure that money just in case there's going to be a pullback. And normally there is pullbacks, but at least you're securing money along the way. That's why we trade. Okay, so that's what a harami candle is. It's a clue candle. Okay, is it enough to go all in on a trade? No, absolutely not. But it's enough to get you thinking about what's happening. Okay, bearish pin bar candle. What is this thing? Okay, so we see these all day. So bearish pin bar opens right here. It comes up green. Okay, so it's a bullish candle when it opens. It opens right here. It's bullish. That's where it makes the high. Then all of a sudden it hits an area of resistance. Sellers push it right back down to where it opens, but the selling pressure continues to push down and make a new low. So it actually came down here like a shooting star candle. This exactly looked like a shooting star candle. It opened green, came up like a bullish candle, then all of a sudden got rejected, coming down. Remember, there's a lot, you gotta, whatever time frame you're trading, you gotta understand what's going on. This could be a 15-minute candle. This could be a daily candle, 4-hour. There's a lot of movement going on, okay? But the closing will tell you more information. So we opened bullish, came up, made the high, came down, selling pressure continued to push it down here, but maybe the last minute of the candle, maybe the last 5 minutes of the day, there was a little bit of buying pressure that came back up and closed it right here. So did we close with all the selling pressure at the low down here? No, the wick is showing us that we closed right here, but there's a little bit of a body of red volume still in here, located lower than 50% down here. So we kind of got to give the sellers the benefit of the doubt in this candle, that they controlled it. Okay, they at the opening price, the buyers were in control. Then when it came up there, the sellers were in control. They pushed it. I give full like sellers were in control down here, but the candle never closed down there. It came back up and closed right here. So to me, if you ask me, is this candle bullish or bearish, I'm going to say to you bearish. Okay, there's still red volume. They kind of closed it near the low, but not at the absolute low, but they're still below 50% of the entire range of the candle. So if you measure the entire range, you measure this wick, the high to the low. Let's say, for example, this entire range is 20 pips. Okay, do you guys understand what I mean by that? The top of the wick to the low wick. If I was to get a ruler and measure that, let's say for argument's sake, it's 20 pips. What's half of 20? 10 right there. So let's say they closed it down 7. Okay, so I got to give the benefit of the doubt. The sellers are in control still, but there was some last minute buyers that came in. So I still got to respect them. So maybe the next candle will open green and come back up, but then we'll see what happens here. If it comes back up, the long upper wick, remember, they got a lot of distance to make up. It's not like it's a short wick. So they got to come up, but by the time they're coming up, the supply might be coming down and push them down and extinguish them. And then the sellers push it down. We take out this low, and then the market is continuing to drop down. Okay. So a pin bar pattern consists of one candle, which represents a sharp reversal and rejection of price, both ways. But we look at the upper wick. The pin bar reversal is defined by a long tail tail, shadow, or wick. The area between the open and close of the pin bar is called the real body. So again, where the volume is the real critical volume. The wicks just represent the range, what happened. But the opening and closing price is very important. And pin bars generally have small real bodies in comparison to their long tails. A bearish pin bar has a long upper wick indicating rejection of higher prices. The tail of the pin bar shows the area that was rejected, and the implication is that the price will continue to move in the opposite direction of the point of the tail. Okay, so, and then also the real bodies. See how it's a smaller body? Is this as significant as a bearish engulfing candle right here? Like this big red body where it closes with all of its red volume, okay, like here where it closes with all of the red volume, that is like importance, 100% probability that sellers are in full control. Okay, we engulfed all the buyers, and it has all of the volume closing near the low. Okay, and then this one, okay, shooting star, same thing, came up, back down, closed near the low. It's got a little red volume, but it's closing near the low. Now when we look at the pin bar, see, it didn't close near the low. That would have been a shooting star. Or yeah, shooting star. It came back up and closed right here, but we still have a little bit of red body volume. It's not as significant as a big red volume body candle, but we still have to give emphasis that sellers are still in control of this candle, but not as significant as the prior bars we just talked about. Okay, let's take a look at on a chart how it looks. Okay, so again, selling pressure, higher time frame coming from up here, finds a support level. We see the buyers come back in, pull back down here. Again, did the selling pressure have enough momentum to close it below that green line? No, there was interest in buyers. They're buying higher low, higher low, higher low, holding the support level. All of a sudden it comes right back up. Okay, and then we break out. Okay, again, here's another example of an impulse breakout. So this candle opened green, impulsively broke out of here. Okay, but if you're waiting for the entire candle to close, 5 minutes, it got rejected and came down. Sellers in control, sellers in control, sellers in control, sellers in control, where they pushed it down near the low, and then there was a little bit of tiny buying at the end of the time frame, and then it closed right there. So is it a shooting star? No, because a shooting star would have closed right at the low. Is this a spin top? No, we're going to talk about a spin top next. A spin top is kind of generally right at 50%. You can see that the volume is still red and leaning towards 75% sell side. Okay, and then we closed below that red line. That's critical. Okay, to close below a prior resistance turn support area, that shows confirmation that the sellers have really pushed it down and closed it with a statement below a critical level. Okay, the next bar then opens red, comes all the way back down. Okay, that could have been continuation selling, came down, but again, the body has to close. When it came down here, found some bids, higher low, higher low, higher low, and then the body comes back up. This scares a lot of traders. When you sell and then it comes down and you don't do anything, like not a lot of traders are scalping, but you got to trust your analysis. It came back up and it closed as a bullish pin bar. So next candle should open green, which it did, and came up, but it's got a long upper wick that the buyers got to continue to climb up a big mountain. Okay, so it came up, but then the sellers really pushed it down and closed it near the low. Look at the retest. Next candle opened green again, green, 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 right up to that red line. Not only, like, they keep lowering it, lower high, lower high, lower high. So they're lowering the offers, keep absorbing the buyers, and then the big move is coming. But when you take this trade, whether you took it here, here, or here, make sure your stop loss is minimum above the prior high of the previous bar. That's just logical. I thought most traders knew that. Some traders are trading, they get in a sell, and then they're giving it like 3 pips. And then you see this candle right there, you're stopped out right there. You're stopped out. And then you're missing out on a huge move. Is because you're being too tight. It's because you're trading with such big lot sizes that you're scared of a 5 or 10 pip pullback. Okay, guys, lower your lot sizes and increase your stops just a little bit. I guarantee you your profit loss, your journal will change overnight if you just listen to what I'm saying. If you want to change your mindset, okay, just understand that if you really do your candlestick analysis and you know where to place the stops appropriately without risking your account, and you're still happy and confident with the profits, you know, slow, steady growth, you're going to start to build the confidence to trade like this. Then when you get more experience and better and better and better at it, yes, then you can start to increase your lot sizing. But you got to learn somehow. Don't learn the wrong way, how I used to do it. When I started trading, I was learning like that. I was learning by over leveraging my accounts, panicking when there was one small pullback, and then getting scared. Now just give yourself some room to breathe, okay? And you'll see how this play developed, and then it ended up breaking down where you could have benefited from the move. But it all started with a bearish pin bar at this area of resistance. Okay, it took a while to develop, but got to trust your analysis. Okay, bear spin top. This is the most neutral candle we have. It's kind of, I call this a tug of war. Okay, I'm pulling it, you're pulling it, and then we finish right where we started. But there's a red volume body that's still left in it. So that's why it's a bear spin top. We've seen the same one last week with a green body. It's a bullish spin top. Okay, so it's very neutral. These candles are the worst to trade unless they develop at a specific area, at an area of supply, higher time. And what we're seeing is a lack of pressure and volume, and maybe a possible reversal in the market. But these are like least significant candles. I would focus more on the bearish engulfing, the shooting star, and those ones. Okay, but still know what a spin top is. A bear spin top is a Japanese candlestick pattern with a short body found in middle of two long wicks. Short body in two long wicks, red body, bearish. A spin top illustrates a situation where neither the buyers nor the sellers are in control for that time period, as the market is closed neutral. Okay, indecision, range. This is where we kind of want to trap all of this volume, and then we wait to see who will get squeezed out of here. We're smart. We know that either the buyers are going to take it out of here or the sellers are going to take it down here, but it might need time to cool off, catch its breath. You know, you don't need to be trading this garbage and getting frustrated. Wait, be patient, trap it, and wait. Okay, so a spin top in a consolidation period illustrates that price action is just trading sideways, as I just mentioned. When a spin top forms after an uptrend or downtrend, it can be a clue. This is the big word, a clue for a reversal in the near term. Okay, a lot of trading gives us, a lot of price action gives us clues as to what is going to happen. Okay, remember, we can't predict the future. I would love to if I could predict the future, but we can get clues and learn from previous price action where momentum is moving, and that's kind of what we want to trade with. But it does take patience, it does take discipline. Sometimes you got to wait for bodies to close, and then you see that you missed out on some impulse moves. But just telling yourself every single day, today is a day that I'm going to wait for bodies to close and just test out this theory. And I'm only going to trade impulse candles unless there's a nice buildup leading to that impulse. You'll kind of know when it's building up. If you see like a big massive red candle come down and all of a sudden it picks up a big wick and it closes near the high, I have a high probability that if the next candle opens bullish and it's got like not a lot of resistance to the left, it's probably going to break out of there, and that might be an impulse trade. But there's a buildup that led up to that. You know how it came down selling, all of a sudden it met all the buyers, a big block, bought it, and closed it near the high like a hammer, and maybe the next candle will break out with that momentum. So, but not always do we see that in the markets. Okay, so if you're trading this, you see it sideways, the market is relaxing, so maybe you should relax too. Maybe as the market is consolidating, you got to consolidate. Maybe go for a drink, go for a walk, trap it, put some alerts on your chart and come back. Okay, don't be getting caught up trading this garbage. It could get very frustrating because you might see a bearish engulfing candle come down, and you're saying, Ron, that's a bearish engulfing candle, I got to take that. But again, remember the context where these things form. If a bearish engulfing candlestick is forming in an area of a range, it's just probably barcoding. It's going to be red, then the next candle might be bullish engulfing, come right back up. Then it might come down red halfway, next one might be green. But yes, there is technically a bearish engulfing candle, but again, I'm going to ask you, where was it created? And if you tell me it was in a consolidation range, I'm going to tell you, yes, that's what I've been telling you. Was it not? We give more emphasis if it was created at a higher time frame area of supply, a bigger block. Inside the consolidation, who cares what's going on in there? Okay, that's where they trick you. Because you're trading the worst volume. That's if you are trading there, slow, steady, accumulate with the market, small baby sizes until you figure out the move. Then you can start to move with the market with your normal trading sizes. Okay, that's where you're speculating. That's where you're adding feeler trades in the market, because in case you get stopped out, you're not damaging your entire account, guys. You're taking a small little hit where it doesn't even, where you don't even look at it. Okay, if you're trading with, for example, a $50,000 account and you're trading with 10 cents and you get stopped out at 30 pips, you lose $3. That's not, you're not close to your daily drawdown. That's not enough where it's going to destroy your trading day. It's a learning experience. Okay, and then if the market is moving your direction, then obviously then step up your sizing to what you feel is comfortable for you. I'm not saying step up to Lambos, but step up to something that you're comfortable trading. Okay. And let's see here. Spin top candlesticks should not be mistaken with pin bars. This is what I see. A lot of traders get them mistaken by pin bars. Remember, pin bar closes red, less than 50% of the range, more 3/4 down. See how the neutral spin top closes right, basically right in the middle. So we opened, it came up green, it got resistance, it came back down where red, where sellers were in control, came down here near the low, then buyers bought it right back up, and look at where we closed. We kind of closed right where we opened with a little bit of selling pressure. Okay, so is that enough for us to take the next trade? No, because buyers could take it up and sellers could take it right back down. Okay, let me just grab a drink right here, guys. My mouth is really, really dry. I got Pepsi Max today, Pepsi Max. I normally like the Coke Zero. Okay, bearish spin top. Okay, this is how it forms. Resistance, okay? Real bodies, place a line across. What happened? We had an impulse bullish candle break through here and close right here, inverted hammer. Next bar again. We came up green, but see how many rejections we have above here. Rejection, 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 rejection. We don't have any real solid volume closing above this red line. Then there's our bearish spin top. It came down, closed, but the closing, okay, when you look at the size of the body too, we look at red volume. But I always look at the critical line. That's why I do a top down. That's why I put emphasis more on the yellow lines, daily criticals, the purple lines, the high and low of the day. White lines on my chart are the hourly support and resistance. And when I'm trading the 5 minutes, I watch for like 5-minute volume to close below. Let's say if this was an hourly line, okay, instead of red, it was white, like how I normally put. It's white. And this is hourly. So I start to see 5-minute rejection, close below, push down, come back up, impulse, close right at the line. Again, impulse, lower high, continue push down, close right there. Okay. And then now I see the volume closing below. There's the retest. I might want to continue to sell. Does that not look like a double top now when I put the puzzle together? Not only am I looking at a spin top, I'm looking at no positive green volume closing above this red line. Double top, here's one leg come up. There's our neckline right there. And then it comes right back up. But then there's our double top, spin top, indecision, and then our ignited red bar, elevator coming down. Okay, why am I showing emphasis over here? Because this is the second leg. This is the more powerful leg of the double top. So now when we learn our individual candlesticks, when we learn our resistance areas, now you put a pattern together. Now you're giving yourself even more confluence. So now, did anybody see that this was a double top, or were you guys just focused on the candle right here? Did you guys actually see it was a double top before I even said M top, double top, or no? Be honest, guys. Rodney, you saw it? Good eyes. Okay. A lot of traders are just looking at now individual candlesticks. But when you learn now the momentum of the candlestick, where they open and close, that's why I pay so much particular attention at these critical levels. And then you put the puzzle together, then you see the double top, then it might be time to sell here. Place your stop loss again, maybe above the previous high, or you look to upper structure above you. But normally with a top down, you would already have it done. You would know exactly how much pips to risk, where's your next resistance level, and how much are you willing to risk. And then we want to come down to the previous area of support, the neckline. And look what happened. We came down very bearish, closed below the green line right here. This is where it started to come up. See all the wicks. Okay, the buyers were pushing it up, but now we actually closed below all of that area. Any retest to the green line, we want to continue selling. I would look now 50% of this red candle and draw a red box across just in case it pulls back. Maybe we're going to continue pushing down, and then I will sell with this momentum until we find our next support area, and then maybe the market may reverse back up. Okay, but this all kind of developed with a whole lot of information here. This impulse candle that broke out got rejected, closed. This is an inverted hammer candle. Okay, and then the next one opened green, came up. It didn't fill the previous wick, lower high. They pushed it down. We broke the low of this inverted hammer. So sellers are setting a statement saying, hey, we're controlling this next move because we had enough momentum to take out the previous low where all those buyers were holding right there with that ignited bar that opened up. They had enough pressure to push it down and create a new low. Now, is that enough to take a trade? No, but because anything can happen when you break new lows. There could be new bids in the market, and there was. It brought it right back up where it closed pretty neutral, right in the middle. But then we use analysis of the next candle, come up again, lower high, and break. If you don't sell right away right here, you can maybe start to sell down here below the next low, and then place your stop loss above there and try and run it down. Okay. But that's, guys, you know, like candle by candle, bar by bar trading, putting together support resistance areas, putting together bigger patterns in the market. And then then you see that you're becoming a trader. You're starting to really analyze the market properly, as opposed to just some traders that guess. You know, I see a lot of that. Traders are just guessing. Okay. Trading is not guessing. Trading is you're taking the best probable setups that you can. And are they always going to go into profit when you see this pattern? No, I wish I could tell you guys that. There's manipulation that happens every single day in the markets. Even if it presents you with your A+++ setup and you swear you take that trade every single day, there might be tomorrow that's not it is an A+ setup, but when you take it, all of a sudden it's a huge bullish candle and you're like, what the hell just happened there? Okay, that happens. We can't control that. Okay, the only thing you can control is taking the best trades possible by doing the best analysis to your ability and not over leveraging your account when you're taking the trade. That's it, guys. Keep trading simple. Stop making it so complicated for yourself. Okay, and let's just move on to the hanging man candlestick. Okay, so what is a hanging man now? It looks like a hammer. Everyone calls this a hammer. It's not. Why? Because a hammer, remember, has a green body. This is a bearish candle. Why? Because it opened up here. It opened red. It came down. It was a bearish engulfing candle coming down, 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 all the way down here. When it reached the low, there was a big block of bids and support. And then it came right up with those buyers, came up buyers, 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 buyers. And then look at where they closed it. They closed it right here. So it opened red. The destination was coming down with sellers, driving all the way down here. Then we met our buyers, picked up our buyers, and then they came right back up and they closed it right here. So for us to say that this is a bullish candle, it's not. It finished off with bullish momentum, but we still have this red body of selling pressure still in the candle. Okay, so what we need to do to flip this is next candle may open green. Why? Because of who was in control going into the close of this candle. The buyers. The buyers had momentum. They were coming up, coming up, coming up, coming up, and they closed it. But we still got to respect the sellers are still sitting here. So the buyers now, I always assume that the next candle is going to open with the momentum how it closes. So I assume it's going to open green. And when it opens green, I look for it to come up and engulf this body. I look at how long the wick is as well. Is it a long wick? Is it a pin bar? This candle has no wick. Okay, so easily, if buyers continue to break this out, it might be a bullish move continuing to break out of here because we had the momentum come off of here and we engulfed this. But normally when these hanging man candles, the next bar opens, a lot of buyers think that and then they buy, but they get faked out by the market because it's still closing with a lot of selling pressure where it opened. So the opening sellers, they're still there. Okay, so maybe the next bar is not going to open green. Maybe they gap it down, or maybe it just comes up a little bit, but then the sellers continue pushing it down. Then we just got a continuous selling pressure, push down the wick because those buyers that initially bought, now we take them out of the market and then we break our low, and then the market will still push down. But you still got to give this head significance because it still finished with a volume red bar. Okay, there's still selling pressure. Okay, so the hanging man is a bearish reversal pattern made up of just one candle found in an uptrend of 3 or more bullish candles. It has a long lower wick and a short body at the top of the candlestick with little or no upper wick. A hanging man is a key piece of evidence that market sentiment is beginning to reverse the uptrend and the bullish strength is no longer there. Okay, the candle shows that there was significant selling pressure, but the buyers continue to push the price up to the open. A hanging man candlestick can be red or green and is still considered bearish. I put this in there because this is where I want to have a little bit of a debate, okay? Because some traders say hanging man can have a green body. If this had a green body, it's a bullish hammer. Why? Because it opened, it came down, and the buyers were in full control. Then it passed the opening price and closed at the high. So that's showing me that this would be a green body. Buyers are in full control. That's a hammer candlestick. So that's why if it has a red body, it's a hanging man. If it's got a green body and looks like this, it's a hammer. Okay, they're two totally different candlesticks. Okay, and let's look at it on a chart. Okay, so right over here, hanging man candlestick, how we find our support level down here. The buyers are in control, bring it all the way back up to maybe an area of higher time frame resistance. When we do a top down, we see this area comes up, gets rejected, impulse close here. Then there's our bullish spin top candle, indecision up here. So these indecision candles give you clues that the market is now indecisive. It doesn't kind of know where it wants to go. It's kind of anybody's guess here. The buyers, if they close with more green volume up here, yes, they could take control and push it up. But sellers are pushing it down. We got to respect them up here too. They're selling, they're pushing it down. So now the next bar opens red, ignited, no buying pressure, nothing up here. It came down red, 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 all the way down here, but the body never closed down here. Remember, this is a 5-minute candle. So it came down, and when it came down here, it found bids. And then buyers brought it right back up, buyers, 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 but then we closed right here. So we still closed with the opening ignited head. That's important, guys. It's ignited. So we opened up bearish right off the top, right off the open, okay? It was in full control of sellers. They didn't even allow it to come up with a small pullback, nothing. So it's a statement candle, okay? And then it pushed down, the sellers were in full control, but there was a big tranche of bids that came in here and pushed the market, but we still closed right here. So this big head is still red volume, and look at where they closed it. They still closed it below this critical area. So maybe that's not enough to take a trade, but maybe my next bar is where I'm going to take the trade. Okay, so right here it opened. I assume it's going to come up green to maybe test 50% of the volume or the resistance, or maybe one of these upper wicks. It didn't. It opened up bearish again. Maybe I take my sell here, stop loss again above the body of this, but you're really tight if you do that. Maybe your stop loss, you want to be above the previous high where those buyers got rejected up there, okay? And if that's not enough for you to take the sell there, there might be another opportunity on this candle, okay? Just follow it. If you never got in here on this candle, follow it. Did it come down red? Yes, yes. Did it fill that wick? Yes, it did. Did it break a new low? Absolutely. What happened when it broke the new low? Obviously, it's probably going to pick up some bids. If I had a line going across these bodies, probably would have kissed it perfectly. And then we got a little last minute buyers come in and close it right here. We still have big bearish body. Now use what Ron tells you, okay? Did the next candle open green or red? It opened red. Did it push? Did it even attempt 50% of this bar of this candle? No, it opened kind of ignited. We got a shorter wick, so maybe this one can push down, pop. You could sell down here and place your stop loss above these bars if you like, okay? And then next move again, look at where it closed. It closed red below that critical green line, below those critical bodies. This is why I'm very meticulous when I do my charting, because you see this little red. Do you guys even see it? That little red closing was right below that green bar. I know it might not be significant to many of you traders because maybe you don't understand what this means, but this completely changes the entire order book in Bookmap, okay, or any order flow software that you're using, because this is a statement. You know, in sports, when you're watching sports, when you get dunked on and, you know, like that's a statement, okay? You got postered. This is kind of like a statement in trading. The sellers are sending a statement that they closed it below where all the support was, where all the buyers were here. They closed it below the supporting level. So we got to give the sellers the credit that they deserve, okay? But next candle opened green, okay? And no wick here. So it opened green and look at where it came up. It came up to approximately, I'm always eyeballing 50%. You might not be 100% 50%, but you see how it came up green and then got rejected, and then there's your break. No wick. You could add another sell. Like a lot of traders, you guys get very nice trades, but you're not really maximizing on the move. Okay, if you wait patiently for a very, very nice high probable setup and you see it moving in your direction, each candle you could, or pullback, you could add another sell. It takes practice to do that. Don't just do this tomorrow and say, Ron told me to do this. No, it does take practice. You got to really understand what's going on. Then you could add when it comes up here, you're still in your original sell. If you're holding, you see this gets rejected. Maybe I want to take another sell. And then market moves down. You might be in 2 sell positions right now, and they're both in profit. And this is the way how you can kind of maximize your profits for the day with not trading as much. Okay, so again, we'll teach you how to do that, but you got to understand what's going on here before you can add any other positions. Okay, and it all started with the hanging man, okay, up here. So make sure we know what's going on here, guys. And you see hanging man, it's more of the lower spectrum, because it's not 100% bearish where it closes near the low. We had buyers come up all the way up here. So this could have easily turned and went green easily. So this is why least significance, okay, it's at the lower spectrum. The ones that I give more weight to and more respect are your bearish engulfing and your shooting star. You can start to see I'm moving down the spectrum because there was a lot of buyers that came in that one too. But this momentum, perfect breakdown, okay? Dark cloud cover. Okay, remember last week I asked you guys, do you guys know what a piercing line pattern is? And most of you guys said no. Okay, so this is the complete opposite now. How many of you guys have heard a dark cloud cover pattern or understand what this is? Okay, this is now, we need 2 candles. Okay, so it's not enough 1 candle to engulf the previous buyers, but where it closes, very, very important, okay, for psychological traders. I myself am a psychological trader. That's why I follow 50% all day, every day, on any time frame. Don't care, okay? This is a statement. The dark cloud cover pattern is a 2 candlestick pattern, which suggests a potential bearish reversal. It appears at the top of an uptrend and involves a large bullish green candle followed by a bearish red candle. This is followed by sellers driving prices down to close below 50% of the body of the previous bullish candle. Okay, an additional bearish candle is required to complete the dark cloud cover and engulf the previous bullish green bar. The dark cloud cover is signaling a downtrend as sellers outweigh the buyers. Carlos, does a dark cloud necessarily need to gap up? No. Okay, so this is another thing. I was just going to get to that, Carlos. So you see here where this bullish bar opened down here, just a quick little low, and then it came up, bullish, 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 made a high. We closed near the high. So we got to give emphasis that this candle closed strong. Respect to the buyers. Okay, Carlos, the next red bar, if it opened, could have opened right at the close, could have opened right here, red. Okay, in this example, what they did was they gapped up the market. Why? Maybe they gapped it up to come and get the pending orders quickly, because maybe the market makers know, Carlos, that they're going to bring the market down, but they see a little bit of liquidity. They see some money up there, right? So you know what they do. They go up there, get that money. They got it in their pocket. Now let's move. Okay, so do they have to gap up? No. I'm just trying to show a scenario where sometimes they can gap up, but this could also open right here, red, and then just continue going down. Okay, just like a bearish engulfing candle. It can go, It can gap up or it can just open side by side, okay? But if they gap it up, kind of like gives you a little bit of a clue too. Why are they gapping it up? What is the reasoning behind that? Okay, so they gapped it up here. They pulled it green higher, maybe got some FOMO buyers. You know, like think about it, Carlos. You know, when this big bullish candle closed above here, now when they gap it up and turns green, how many excited FOMO buyers are buying up there, right? So they're buying into supply where the market maker knows they're going to bring the market down, but they want that last bit of money. These guys will not leave a penny on the table. They'll take everything from us, and then they reverse the market and screw us over. Okay, so remember, if you waited for like the body to close or you question that opening, maybe don't take the trade. Always question the market, guys. If you see something that is not normal, question it. That's what I do. If I see something that, hey, why didn't it open side by side? Why are they gapping the market up? Should I be trading that or should I wait? Just things like that. Just always question. And then maybe you sitting back questioning and speculating, then maybe you'll save yourself a trade. Instead of buying, maybe you start to see, okay, now I see sellers are in control, pushing it down. They came all the way down here and closed it right here. This is what a dark cloud is, okay? Remember 50% of the previous green bar. Open, close. That's about half of it right there. Look at where we closed. So the sellers had enough momentum to close it below 50% of the green bar. Does that make it this a bearish pattern? No. It would have been bearish engulfing if the entire red bar closed below here. Then we closed out all those buyers. There's still a little bit of buyers still left in the market right here. So now what a dark cloud cover is, the key points are we closed below 50% of the preceding bullish bar. Now we need help of our next buddy, our next red candle, to maybe complete the pattern and engulf this green one. So it will take two red ones to engulf one green bar. Okay, does that make sense, guys? But the most important thing is closing below the 50% level of the preceding bullish bar. We talked about this last week. Opposite pattern was called the piercing line. This one for the bearish is called a dark cloud cover. Okay, and where do they form is of importance. Okay, if we start to see this type of move maybe formed at a higher time frame area of supply, maybe then we gotta keep analyzing and go with the market here. So let's look at what it looks like on a chart again. So you see the bulls, the buyers, they're in full control of this move. They keep taking it up, higher highs, higher lows, higher highs. All of a sudden we see a resistance level. Now, where did I get this red line from? Did I just get it for chart patterns right here to make everything look like this is how it looks every time when we trade? No, guys, we made these, I think like 4 or 5 years ago, and this was from the way how I chart, the red line. Like this is where I got from a higher time frame. If you follow this chart, guys, if you can pull it up, you'll see that I got this from a previous area of resistance in the past. I brought that line, static line across, and I just trade right here from the green box coming up to the red. If I'm in a buy, I secure my profit, then I watch what's going on up here. And then maybe I go in with the reversal. But right here, here's your dark cloud cover, okay? So it comes up green up to a previous area of resistance. Where did I get this red line from? I didn't just pull this out of my hat. That's why top down is critical, because the 5-minute volume maybe came up to an hourly resistance. Maybe these 5-minute candles are getting overbought. They're getting tired, and now it's time to cool off the market and reverse it. But look what's happening here. Okay, so we got the big bullish engulfing candle, about 50%. Even if you eyeball it, this is how I trade. I just eyeball it. I just put a line right across and I follow it, because I've been doing this for so long that do I need to use like a Fibonacci or this or that? You can if you want to get the exact levels if you like, but just try, guys. Just try tomorrow. Just big body candles. Put a line halfway through it when it closes and just see how your trading changes. Okay, now we see the red candle. It opened green, came up. Did it even take out that wick? No. So they kind of pushed it down. Now it's coming down red, right to the 50% mark. But did it come down, our first slide, did it engulf the entire green bar, close down here? No, it didn't. Did it close below 50% of the green bar? Yes, it did. So this is about 75% engulfed. Can we say that, guys? Like, it's not 100% engulfed. It's more than 50. Let's say 75%. We still got this little green body left. Okay, right there at the bottom. That still represents buyers in the market. So what we need is, we need help of our next buddy to complete the pattern. So this one opened red. Did it come up to test? Again, 50% maybe of this red bar. I would move this line a little higher up to there to represent 50% of the red bar. No, it didn't. No wick, so continue to push down, make a new low, come in, trade into 50% of this green candle. Look, sometimes I don't even need to use lines. I can just see these things. And then it comes up and look at where it closed. So this red bar and this red bar closed below and engulfed that green one. So now there's a little bit of sideways consolidation. Okay, so any one of these candles, if I sold this one, if I sold this one, any one of these, my stop loss, number one, would be above these previous wicks. Okay, if you really, really want to get tight with trading and you're very conservative, you could go 50% of that red candle. But knowing the markets, guys, they might come up and come up there and tag you, take you out, and then you're going to miss out on these two big red candles coming down. So again, don't be too cheap on your stop loss. Give it some room to breathe, and maybe you're going to get in more profitable trades and you're not short selling yourself. Okay, just decrease your lot size a little bit if you have to open up your stop loss. It's simple mathematics. If I'm risking a standard lot, okay, standard lot, and I'm giving this only 10 pips to breathe, I'm willing to lose $100 on this trade. Okay, I'm just using these numbers for example. Now, maybe I want to give it more than 10 pips to breathe. Maybe I want to give it 20. Okay, but if I use that same standard lot, now I'm risking $200. Maybe that's too much. Maybe my maximum risk on this trade is $100. I can't do 200. It's too much. So what I'll do is I will increase my stop loss 20 pips, and I'll divide my lot size in half. So instead of doing a standard, I will do a 0.5. I'm now $5 per pip, but times 20 pips, I'm still risking $100. But I'm giving it more room to breathe. Okay, so just do that, guys. Give it room to breathe. At least respect the structure. Okay, and then trade a security. Like when we're trading US 30, this could be US 30, and the structure might be 25, 30 pips. And a lot of traders say, holy shit, Ron, I can't put a 30 pip stop loss because I trade GBP USD with 10 pip stop loss. But this is a completely different world you're trading now. This is a different type of security. So you better get used to how US 30 or NASDAQ or how gold move. Because if you think you're going to trade gold, US 30 and NASDAQ and oil with a 5, 10 pip stop loss, you better be nailing your entries with zero drawdown and go right into profit. Okay. And how many of you guys can do that on a consistent basis? Not a lot of us. Okay. It's very hard to keep up that momentum. So got to give it a little room to breathe, guys. Okay. And I promise you, it will make your trading even easier. Okay, you're not going to stress out because now you can watch plays develop. You might be now focusing on the price action and not so much your MT4, and then you might be able to say, holy shit, Ron was right, it closed below there, consolidated, trap that. Look at this, no wick on the bottom. I got another ignited bar. Maybe I could sell that candle. Look at the pullback, come up green. Did it come up? Ron said 50%. No, God, but look at that, no wick, pop. What does Ron say? Maybe you could have maybe executed 3 sells on this and be done for the day because you waited for a specific trade to come to you. You didn't force anything here. You waited. You waited for the body to close. You saw it close below 50%. Okay, that should give you a clue. Ron was talking about dark cloud cover. What do I need next? What's the next piece of the puzzle? I need it to close below there. Okay, now I put the piece to the puzzle together. Now I understand what consolidation is. Did it come back up and buyers? No, it pushed down. So even right here, you could have took a sell right here if you didn't get involved in it, but understand the clues that these bars are telling you. And then there's your nice sell. Okay, that's dark cloud cover, guys. Most important is 50%. Okay. Okay, now we have a 3 bar evening star. Last week, bullish family, we talked about the morning star. This is just the complete opposite. Here we've got a large body bullish candle come up. Then we have our little indecision candle right here in between. It can be a doji, it can be a spin top, okay? It can be anything in here, but indecision, okay? And then it's followed by a big red bearish engulfing bar. So 3 bars, 3 bar play is an evening star. These entire 3 candles make up this move. Is it always going to, when you spot this, is it always 100% going to sell off? No, okay? But this is good to know some patterns just so when you spot them, maybe you might be able to make better educated educated guesses, okay? The evening star pattern consists of 3 or more candlesticks. It is a 3-candle pattern, one short-bodied candle between a long bearish and long bullish candle. The third candle's strong bullish close is a sign of growing buying momentum. Normally, the star will have no overlap with the longer bodies. The evening star pattern indicates a reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candlestick. So you see a big bearish engulfing candle, take out that first candle, and then you got your little indecision star in the middle. Okay, so let's take a look on charts, how it can look. Here's a bullish trend coming up. Push up, okay, close above. There's my little indecision doji star just closing above here. So it's showing maybe something, a clue that something might be changing in the market. Then all of a sudden I get this red candle close below. I wanted to show this one as well, okay, that sometimes patterns are not going to be always 100% guaranteed, where we need this red candle to close below here, okay? That would have been higher probability, but just because it didn't close below there doesn't mean that you cannot still think about a trade opportunity, okay? I see a lot of traders are getting really analytical and really technical, and then they're missing out on the move because of like 1 pip or 2 pips, okay? So just understand context, okay? Context. Do we have like a 3-bar evening star? Yes. Did this third bar completely engulf? Because that's technically what a definition is. It didn't, okay? But we can still go with the momentum, okay? We got to break this green line. So the next candle opened green. Did it come back up to the retest line? Did it come up to 50%? No, it's still pushing down, okay? So you could take, if you took a sell right there, it's impulse, okay? But then if you waited for it to close, we got now full confirmation that these 2 bars close below that green support line. We engulfed that green bar, and now assume it's going to open green, come up, got rejected. I could sell right there. Sell right here, stop loss above structure, and then ride this down. And then you could get some bearish continuation and get into profit, okay? Do I show like, do I trade evening stars and morning stars? Not really. I trade more bullish engulfing, hammers. I trade pin bars. I trade bearish engulfing. I trade shooting stars. I trade the more like momentum candles. This is a nice setup, but even this, if you don't catch the evening star, you can still catch a red bar. Did it close below 50%? Yes. And then you need the help of the next candle. This could also be a dark cloud. Like these 2 candles right here. I know someone's going to say, Ron, but the indecision doji candle in the middle. Okay. Again, then we're getting real technical. And then this is where like traders are really confusing themselves, where they're adding too much fluff. And just stick to what works, guys. You know, common sense, okay? And then if someone wants to argue, Ron, well, it's not technically a evening star. Ron, technically, it's not a dark cloud. Ron, technically, it's this. You're confused. You're just adding too much confusion, guys. Keep trading simple. Keep it simple, basic, and you will see you will go that much farther in trading when you keep it simple. Stop confusing yourselves, okay? Don't make this more complicated than it needs to be, okay? If I was teaching my son right now, okay, I'm being honest with you guys. My son's 12 years old. I teach him all the patterns. I wouldn't waste my time with this evening star until he really understands price action. I would be teaching him the bearish engulfing. I would be teaching him the shooting star right now. I would teach him what are indecision candles. Those are the ones. Would I focus right away on this? No, because it might confuse him. And when he's ready to learn about 3-bar plays and more advanced stuff, then I'll teach him. But to start him off, I'm going to teach him the basics. Like he knows what a bullish engulfing is. He knows what a hammer is. Those ones. Those are the ones that will make you money, guys. So yes, as you get more and more advanced, then start to learn 3-bar plays and things like that, okay? And this one too, 3 black crows. Okay, very simple. The other ones were the 3 soldiers, the bullish ones. So 3 black crows, a bearish candlestick pattern is predicted the reversal of a current trend. It kind of, we put more emphasis on higher time frames. Like if these were 3 daily red candles, you know something is up in the market. Like it's really bearish. If these were just 3 1-minute candles, it is important, but maybe 3 1-minute candles, the next one is going to come up green, okay? But this could indicate real selling momentum when you see 3 consecutive bars, if they're like all ignited and they got low wicks and low high wicks, low. So yes, you got a lot of selling pressure coming in the market. But I kind of like to take the trade up here, be in the trade, then I profit as they're coming down. But if you're not in a trade and you see 3 big bars coming down, then yes, the market might be coming down very bearish. But you also have to understand there could be maybe a potential pullback that comes up, then goes down. But that's not necessarily always the case. Okay, so the pattern consists of 3 consecutive full body candles. Each candle closes lower than the previous one with a small or no wicks. These patterns are mainly used on higher time frame, daily or 4-hour, where each candle represents an entire trading day over 3 full days, establishing a strong reversal. So you might see it on charts. This is a 15-minute example of Euro GBP. See this consolidation period. The buyers brought it right back up. Then it's followed with, what did we learn today? A big bearish engulfing candle at an area of resistance. Take out that. Our next bar ignited, red, no wick. Did it even come up to test 50%? No. So we should be selling this candle. Sell, stop loss above here, run it down, and then there's our next 3rd bar. Okay, this is not technically like a real definition of 3 black crows, but you can get the understanding that we close below support level, then the sellers really push the market down. But I kind of look to sell like up here and then here. So, but if you miss it and then you're getting in down here, just understand that you're getting in the market when it's already sold quite a bit. So you could be selling down here and it might pull back. And then, so don't always go with this. Okay. This is why I leave this one for last, because this one can be deceiving. Okay. Because if you're waiting for 3 full bars, you'll see it, but then you might be selling down here. Then all of a sudden the market is rotating right back up and you're in drawdown. So that's why I leave this one at the end. Don't put too much emphasis on this one. Okay. And then this one too, Gravestone doji. Okay, so this one just has no green or red body. Okay, what happened here? It opened, it was completely bullish, where it made the high. Did it close up there? No, because maybe there's maybe minutes left on the candle. Then it continues to come down, selling pressure, selling, and then it closes right where it virtually opened. So if something opened at $10, it went up to $15, then all of a sudden it comes down 14, 13, 12, 11, and then it closes at $10. So who do you give momentum to on that candle bar? I'm going to give momentum to who closed it. Okay, so my momentum is that the sellers have control going into the next bar, just because of how it closed out. But when this candle opened, the buyers were in full control. But remember, we can't judge an entire candle until it closes. So that's what a Gravestone doji is. A Gravestone doji pattern can be interpreted as a bearish reversal when it occurs at the top of uptrends. The Gravestone doji resembles an inverted T. Okay, remember the one on the bullish one was a dragonfly doji. This is the opposite, Gravestone shaped candlestick that is created when the open high and closing price are virtually equal. The most important part of a Gravestone doji is the long upper wick, showing the big selling pressure that we've exhausted all the buyers. The dragonfly doji is a single candle pattern with a long wick and with a long lower wick and no upper wick. Dragonfly doji resembles a T. Okay, so let's look at on a chart. Okay, do we trade dojis? Not necessarily. You're not going to see too many of these candles formed in the markets, but if you do, have a good understanding of what it is. So here was a prior resistance level. The market came up bullish, came up, impulse break, come back down, and close right virtually where it opened right at that line. Then the momentum shifts where selling pressure will continue to push the market back down and test this support level. It came down, buyers brought it right back up. Again, this resistance, impulse break, again, impulse, close below, and then we continue to close with red volume below now this green line, and there's the retest, come back up, 50% rejected. You could continue to sell the market down here. Sell here, add another sell, okay? Or sell, take your profit, see it come up, maybe the market is coming back down, and continue with the selling pressure. Then maybe you already pipped and dipped out of there, grab some pips, and maybe you see the market is continuing to push down, continue to sell with the market. Look at the trend. It's coming from a higher time frame. It's coming, the rally is up here, coming down, sellers are in control, small support, comes up. Again, that dragon the Gravestone doji gives us a clue. It got rejected hard, closed down there. Maybe we're going to continue come down. This could also, you could consolidate this entire area. Then when you see the red body close below the retest, that could be your selling opportunity, but you're getting clues with what's going on. Okay. Do we need to show emphasis on Gravestone dojis? No, maybe focus on more of the traditional candles that you see a lot of, okay, but still have a good overall understanding of the entire family of bars. Okay, but that's it, guys. 640. Okay, so that was the entire bearish family. Last week we went over the bullish family. So again, I'm not going to go too much over candlesticks. We already have a lot of courses on them. We've done multiple webinars on candlesticks. This was kind of a refresher. So hopefully now, guys, are you guys getting a better understanding of price action and candlesticks and why it's important to wait for candles to close? Because it will give you more information. If you're just making impulse decisions, anything can happen until that candle closes, and it can take you for a ride that you don't want to go on. Okay, so unless you understand how to trade impulse candles, okay, because they're not guaranteed to continue to go into that direction. So guys, thank you guys so much. Appreciate you guys coming in. I know we started this one 1 hour early. Some feedback. Some guys were saying 5 o'clock is really nice right now. Gives them because it gets late when they're studying and on the webinars and things like that. So I'll try my best 5, 6 o'clock. Maybe sometimes we'll do some daytime webinars. We'll mix it up. As it gets colder over here and winter, I'm rarely outside, so I'll be inside here with you guys. So guys, I hope you guys enjoyed this webinar on bearish and candlestick family and patterns. Next week, I believe we're going to start to learn a little bit more about wicks now, okay? Because now we got to learn about the wicks, tails, bodies, shadows, whatever you want to call them. What do they tell us, okay? And then we're going to start to move into support, resistance, and things like that. And how do these candles form at those areas? And we're continuing to move forward. So thank you guys so much. I appreciate all of you guys. I just got to take a quick little break, and then I got to get on another Zoom with a member and just go over a few things with him. But guys, I appreciate all of you guys. Thank you guys. And tomorrow is Thursday. Okay, so we got London, we got New York, and then I'll be doing post New York with you guys at 11 o'clock. Tomorrow we'll be doing a little 1-minute analysis. Okay, we'll do 1 or 2 charts, maybe 2 US 30 and maybe gold. We'll do a quick top down, and then we'll follow 1-minute candles. But thank you guys. Guys, thank you to Trista and Ian, who are making these nice presentations for us. So Trista, thank you so much for this. And Ian, really appreciate you guys. Nice formats, beautiful presentations. Thank you guys so much for this. Yep, CPI tomorrow, Jay Robertson. Yep. Guys, just please trade careful. Okay. Maybe take a little bit of what I said today and maybe test the theories out tomorrow. Okay. That doesn't mean go all in, but if you want to try something new, I always recommend, if you're learning something new, go to a demo account, or go to something live but small. Okay, if you're learn with the micro sizes until you get a hang of everything. You're not going to learn this stuff overnight. Okay, believe me, you're not going to learn this overnight. Some of you guys are really, really fast learners, but it still takes you guys a while to get the hang of this. So take your time, stop rushing the process, stop just focusing on money. I got to make money. I got to make money. That's the only thing I hear every single day is, Ron, I got to make money. I got to make money. We all want to make money, but if you don't learn what you're doing, I'm telling you right now, I'm trying to save you money. You're not going to make money. Okay. If you keep over leveraging and you don't know what you're doing, if you can't distinguish what a hammer and a shooting star candle is, if you can't distinguish or identify an area of resistance or support, and you're over leveraging, you're not going to make money. Guys, I'm trying to save you money. Don't trade like that. Learn the concepts first, then money will come along the way. Trust the process. But if you guys are rushing the process and the only thing you're concerned about is making money, you're making your journey very, very, very difficult for yourself. Okay. And I'm telling that with the bottom of my heart. I've been through there. I've done that. And I promised myself that I'm never, ever going to go down in that direction again. And anyone I'm really talking to, like on the Zoom or one-on-one or a heart-to-heart with somebody, I tell them the truth of my mistakes, and I don't want to see anybody go through that, because it was a uphill battle for me to get through that. Believe me, I know how it is. I've been in your shoes before. I used to only think about making money, making money, making money. And that's when I lost all of my money. Facts. Okay. When I started to really analyze the markets, learn what I was doing, start to study actual price action without over leveraging, trading with a lot size that I'm comfortable with. Who cares what other people are doing? Again, guys, don't be focusing on too much other traders. If they're showing their profits and things like that, who cares? They're doing really well. Let's be happy for them, but we don't know their journey. We don't know their struggle. Let's not stereotype or this or that. We got to focus on ourselves, guys. That's what trading is. It's very mental. It's very just you against the market. It's you against yourself. Okay. I keep saying this. Trading is you versus yourself. It's you versus your mindset. If you allow your mindset to take over, it will destroy and destruct you, not just with trading, with everything. So make sure you got a clear mindset, okay, when you go into these markets. And then you'll perform much better. Okay. So thank you guys, everybody. Have a good evening. We'll see you guys tomorrow. And yeah, thank you very much. Guys, we'll see you tomorrow. Thanks for all of the participation, all of the questions, guys. Really appreciate it. And we'll see you guys tomorrow. Thank you, guys. Have a good night. Thank you, Evie. Thank you, Trista. Alnita, thank you, guys. Have a good night, everyone.
Hey guys, good morning, welcome to another live session of Stock Sniper Trading. My name is Dave, guys, my partner is Ron. Let's get down to business here, guys.
In on US 30, sell, okay? I'm jumping in. Guys, that's a 100 pip drop. Yes, we caught it. Hey, you guys, 200 pips, please, secure.
As a trader, we all look for tight or low spreads, which helps us to get in and out of the market. Using the right broker can help us try different strategies. With multiple options of brokers on the web, here at Stock Sniper Trading, we have a recommended broker, that is, HankoTrade. With spreads as low as 0 pips and leverage up to 500x, HankoTrade is just one click away. With multiple account types to choose from, you also have a minimum deposit of $10. Using HankoTrade's affiliate program, refer a friend and earn up to a 40% commission on trading volume. Built by traders, for traders. HankoTrade.